Good afternoon, ladies and gentlemen. Welcome to our meeting. I can see that we're full. I am the press person of LPP. Thank you for coming to today's meeting. So I would like to welcome everyone who came to the meeting and all of you who are listening to our commentary online. This commentary for the last quarter of 2015 will be presented by the Deputy President of the Management Board, Mr. Przemysław Rutkiewicz. Good afternoon, ladies and gentlemen. I know that there is quite a lot of pressure concerning the comment, so I give the floor to the President. Welcome, ladies and gentlemen. Thank you for coming to today's meeting. I am very happy to see so many of you who came to today's meetings, and I would like to welcome everyone who is watching our online broadcast. As the tradition goes, we will talk about the results of the fourth quarter of 2015, and then I will ask my colleague to talk about the most important events in the brands and our plans. At the end, we will talk about our plans for 2016, our goals and assumptions. Let's start with some big numbers. At the end of 2015, our network had over 1,600 stores, and we were operating in 17 countries. And the revenues, the sales were, LFLs were positive. It was 0.6%, and new floor space grew by 16.7 zloty, which made us to have over 5 million zloty in revenues. We had margin, which was 53.5%. That was the gross profit margin, and we were working very strongly on our costs, which were lower per square meter it was lower by 15%. And we had 503 million zloty of operational profit, EBIT. Well, key achievements. Well, quite a lot of things happened in our company throughout years, but this year we are accelerating, speeding up everything, because we are talking about very good commercial conditions. We will be pushing for further development in Hungary. We will be opening House and Sinsay in this country. We have continued our development in Germany. 2 stores, reserved stores, opened in Germany, and at the end of the year we had quite a lot of stores there. And we can't forget about a dynamically developing online stores. We have entered 4 countries in addition to Poland, and in the fourth quarter we opened online stores in Romania and Slovakia. These are very promising markets, and we are still talking about new countries, and we will be talking about that in the further part of our presentation. And the last information that is provided on this slide, which electrified our atmosphere and mood before Christmas, especially among those who are interested in our industry, because we informed you about a conditional agreement for opening our flagship store in London on the best commercial street of the world, which is the Oxford Street. We will focus on that later on, but let's move on to the next slide for the time being. Well, not really much has changed since the previous presentation. There are no new countries here on this map, but I can say that we have a new store in the United Arab Emirates, so we have 5 stores operating. And now, the growth covering 2015, 111 stores, new stores. The biggest growth is in our latest brand so far, which is Sinsay, but this is not our newest brand, because we have a newer brand now. We will talk about it later on. Now let's move on to some numbers. Now let's start with the most important factor in our industry, which is LFL. So the graph shows you that we had 2.8% growth in the fourth quarter. So it was the best growth out of all quarters of 2015. Well, the whole year was positive. It was not much, but still positive, 0.6%. Another good news is another positive tendency is the fact that in the fourth quarter of the past year, all countries, except of Poland, had a positive LFLs. So LFLs were positive in all countries except for Poland. But we hope for a better situation in the future. And floor space. We had 45,000 square meters growth in the fourth quarter. Poland, 21,000 square meters, but also EU and Russia. This is where we were opening our stores in the fourth quarter. Here on the right, you can see that the biggest growth was recorded by the EU countries. Poland, 12%. Well, we've been opening new brands here. Russia and Ukraine, 7.5% growth. And for the first time, we have a Middle East region here, so 5,500 square meters of floor space in the Middle East. Now, by brands, the biggest growth, half of the floor space. Well, this is a Reserved brand, but also other brands were dynamically growing. Well, we had quite a lot of new openings in the fourth quarter, as usual. Well, the table shows you that the biggest growth was recorded by Sinsay Group. It was, but also the Reserved is also recording quite a strong positive growth. And now let's move on to sales revenue growth. Well, we have new floor space, LFLs. How does translate to the revenue growth? Well, we had 12% growth, and this is the best result out of the whole 2015. This graph shows you that we also have quite a strong growth in Reserved revenues. Well, so far, we've been quite even in terms of all brands and all markets, but because Germany and Middle East is just Reserved brand, this is why we have such a dynamic growth of this brand. You can also see the seasonality that the fourth quarter in 2013, 2014, 2015, the fourth quarter is always the best quarter in terms of trade, commercial activities. Well, this is how that worked last year as well. So the table shows you the average sales, average revenues. The good information is that we have the growth in the European countries and a very small drop year on year in Russia and Ukraine, a very small one. We can't forget about online sales. 3 months ago, we weren't really happy with that sales. Well, this is also characterized by large seasonality. But the fourth quarter, as we can see, is very dynamic. 30 million of trade over, 28% growth year on year. And on the right, you can see how we've been developing our e-commerce in 2015. In May, we launched our Czech store, October, Slovakia, Romania, November, and this week we had Tallinder online store launched this week. So you can actually shop online in Tallinder now, which I encourage you. And soon we will open reserve.com in Hungary, very soon. The margins were under pressure throughout the whole year because most of our commodities inventories are bought in Asia. 90%, this comes from Asia, where we pay in US dollars, and US dollar is more expensive is the price is growing by 20%. And before, we were actually able to easier translate the rate, U.S. Polish zloty rate, but now the competition is so strong that we need to actually increase our prices. But by developing the offer in our stores, well, we try the price to be under control. But this is, of course, a very difficult situation. Now let's move on to cost. On the left, you can see the most important part of our cost, so the own stores cost. So we split it by three things. The biggest part is the cost of rental charges. Well, they are decreasing, so we are below 90 zloty per square meter. But there is quite a lot of pressure in terms of salaries. So it's 52 zloty per last quarter, not just in Poland, but also in Russia and Baltic countries, Romania. Well, the pressure is increasing, and we also have to grow the salaries offered to our employees. Well, of course, we hope that it will translate into sales, but this element is surely growing. And last element, the yellow one on top of it, well, this is just a single cost, one time off growth. This is other costs. So when we open a new stores, well, we use some materials. We need some materials for the opening, promotional materials and so on. So whenever we open a store, this kind of other costs are growing, but we are not planning to. We don't believe that they will be growing significantly. And on the right, the franchise. Well, the cost of franchise dropped by 10% year on year. We've mentioned revenues, margin, cost. Now let's see the balance. Sales grew by 12%, margin by 4% only, because in this take, well, the margin is higher by 4%. The cost grew quicker than the margin, and therefore the profit was slightly lower. Operating profit was a little bit lower than last year. We also had some liabilities in US dollars, and after the tax, we have the net income for the fourth quarter. That is 170 million zloty. In the fourth quarter, we've actually recognized the asset for the deferred tax. Well, the profit was higher than 170 million zloty. So if we deduct this operation from the last year and we want to have a similar profit, well, then you will see the cumulated profit at the bottom there. So we have 25% growth. And the whole 2015 growth of revenues by nearly 8%, gross profit margin lower year on year. We've been actually having our costs under control, but a bit lower than last year. And the profit was quite okay. So the net profits is 352 million zloty. And corrected profit last year, well, the level is slightly, just slightly lower than year on year. Now let's move on to the most important elements of the balance and the cash flow. On the left, you can see the graph showing our inventory. Here we also have quite a significant seasonality. This is when we are doing making the inventories that are sold during the best time. So the drop of inventories in 2015, fourth quarter of 2015, as compared to the third quarter, and the level is 1,572 zloty per square meter. And this is an optimum level of inventories for us. So the decrease in inventories helped us to improve the rotation factors, indicators. So the inventory rotation factor decreased, hence the product conversion cycle improved. And now the capex and debt. So capex in the fourth quarter were 151 million zloty. This is what you can see on the left, and it were smaller than in 2014, which 2014 was 160 million zloty, and the total debt were 491 million zloty. So that was the capex. The debt was lower. Net profit as compared to EBITDA is 0.9, so it is below 1, and we believe that this is a very safe level. And cash flow. Now cash flow. The fourth quarter generated cash. We were able to generate cash. You can see it at the end of the fourth quarter. We had 224 million zloty in cash, and it was the gross profit. It was the profit before tax. And on the right, you can see that the numbers are quite similar. Well, operating CF level comparable to the previous year. Also, investing CF is quite good. A smaller cash flow. We were paying our debts. The fourth quarter is always the best in terms of generated cash. Ladies and gentlemen, that is everything in terms of 2015 results. And now I would like to give floor to my colleague who will take you through the most important key events in our brands. Well, in fact, it is very difficult to talk about key developments when you've got just 3 slides and not a lot of time. But you've noticed, I'm sure you've noticed that we debuted with the first premium brand, Tallinder. Why this premium sector, and why we've decided to focus on a wealthy client? Well, first of all, our brands, well, we can see that the target group is quite full. And we really want to enter this market, luxury market. Well, it is growing market in Poland. We have more and more customers, wealthy customers in Poland, and they would like to spend their money on clothes. The premium brand is addressed at male and females. www.tallinder. Well, it is working. The store is working. This is similar to the brand that you are showing. Well, yes, I'm wearing that now. Yeah, this is the jacket I'm wearing. Well, this is a debut in a sector in which LPP has no previous experience. However, we are focusing on a really good quality of our products, which is a very important factor for the customers. And hence, nearly 70% of the spring-summer collection is produced in Europe, is sourced and produced in Europe. 30% is done by Polish producers. Of course, Italy, Portugal, because it is always a very good quality, especially if we talk about accessories such as belts or bags and so on. In terms of stores, well, some of you saw it already. We want to have the Warsaw store. We want to open the Warsaw store as soon as possible, and I believe that soon we will be able to tell you where it is located, the Tallinder store in Warsaw. This concept was developed in cooperation with the British Britward studio, who also worked for other premium brands such as Hugo Boss or Karen Miller. Summarizing our assumptions concerning the development of this brand, well, we are planning to have 30 stores across Poland. Well, we focus on the best locations, the best shopping centers. We a prestige of a shopping center is important, but we also want a good company for our brand. So 2 years were not. 2 years turned out to be not enough in terms of finding a good location to open a store. Well, we are planning to open 6 new stores in Poland. What's important is the fact that we have started also online store nearly simultaneously with the normal traditional stores. Now we moved on we moved to London. Well, talking about this location that was mentioned by Przemysław. So the pre-agreement was signed. We are waiting for the landlord's decision. And now, in terms of the long rental period, well, this is 25 years. Well, this is a standard situation on the British market. Usually, those kind of rental agreements are long, especially if we're talking about strategic location, which is Oxford Street. Of course, this is the potential of the commercial street, of the high street in Great Britain, in the UK. Well, first of all, the street and the traffic on Oxford Circus. Well, we are talking about 200 million people in terms of traffic, yearly traffic. We are planning to open like 3,300 square meters, and this is how we invest in our brand recognition. This is our marketing strategy. This is the brand that we've always said that we're looking for good locations in the most important fashion cities across Europe. And another interesting news, well, throughout the rental agreement, we are able to sublet the space. So at the moment, we are talking about replacing a BHS store. Recognition, this is important, but we also be responding to the needs of our customers, to the trends that are present on the market. The additional elements that we add to our collection, well, we will talk about it later on, but I would like to mention organic cotton. We know that organic cotton has been present on the market, and it's been popular, and we've been already introducing it this year. But we made one step more. Well, we've proposed that to our reserved brand customers, a more kosher product that is dedicated to those who are especially interested in the environmental protection and the environment and nature. Well, the model from the very first beginning until the very end, so not just a yarn, cotton yarn, but also the further processing, finishing. Well, this is done by the certified facility, and you'll see it in those models that you buy. They will be marked for that. Well, we advertise this collection online. Well, this is dedicated. There is a special a special tab dedicated to that collection. We also advertise it through newsletters that are sent to our customers, and this is the message that we send: a special organic cotton collection. Now, moving back onto a standard slide, which covers the communication with you. I hope that you've noticed the data book that we prepared and sent to you today morning. And I hope that this compendium, this book of digits, the most important digits, well, it will help you to analyze and evaluate the situation. And I hope that later on you will be able to join us in our showroom on Chmielna Street. We prepared the Tallinder brand. So in the showroom, you will be able to actually touch it. We also invited our main designer and producer. They will talk about Tallinder brand. So we welcome you, and we encourage you to visit us in the showroom on Chmielna Street to actually see and touch the Tallinder brand. And the plans will be presented by Przemysław, as usual. 2016 outlook. Firstly, I'll say that we made our table more simple, more clear. But if any of you would like to see our old table, you'll find it in the additional slides in the presentation, at the end of the presentation. So the floor space growth, we plan to have at least 11%, but not all the contracts have been signed. So this 11% are the locations that are guarantees, but we continue working, so maybe there will be more in the fourth quarter. Our target is 11, 12, maybe 13% floor space growth, but we are very restrictive in terms of this floor space. We are talking about good locations, but also good commercial conditions. And if possible, if we are successful, then fit-outs. So additional profits for the owner of the shopping center for building new space. European Union, 17% growth. Russia and Ukraine. We are talking about Russia, mainly 10% growth, and a dynamic growth in the Middle East countries, but the basis is low. And Poland, 6% growth, will be growing here, but not but mainly because of new brands. So Tallinder and Sinsay. Above, you can see where, in terms of brands, Sinsay two-digit growth, but also reserved two-digit growth. What countries? United Arab Emirates. And we will also have Kazakhstan and Belarus under franchise model. How much money are we planning to spend on new stores? Well, CapEx should be about 290 million zloty for new stores, and total CapEx, including other investments, is 370 million zloty. And it would be less by 24%, more or less, as compared to the previous years. What are the goals for the organization? So revenue growth is first and foremost, and it should exceed for floor space growth. Further development of e-commerce. So this is a very dynamically growing channel. So we'll be adding new countries. So e-commerce in Hungary, but also we will also add new brands in Czech Republic, Slovakia, Romania, and Hungary. and a challenge and ambitious goal to keep the margin, gross project margin at levels similar to 2015. And this is where I would like to stop for a moment. So maintaining the gross profit margins when everything is more and more expensive. So at the end of January, we were at the situation that Polish zloty versus US dollar was 4.10. So it is very important, but however, the market doesn't allow us to grow the prices, to increase the prices. So what can we do to actually help to improve our sales revenues? Well, the chances in improving the collections and the number of models, and also the development on new markets. Well, new markets help us to improve the expansion and improve the revenues. And again, China. This is our biggest market in terms of purchases, and you can see that we are dealing with yuan devaluation now. We are often asked whether that means that we can buy cheaper. Yes, we can buy cheaper, but we would like to translate this lower cost into a quality. So we will probably be buying at the same price because we will be investing in the quality of the products that we are buying. And no risks. The risk is the store or trade tax that is now being developed by the government. We still don't know how that will work out. Also, the continuation of unfavorable FX trends, for example, in Poland versus US dollar and euro, and then a continuation of negative macroeconomic situation in Russia. This is a very important market for us. We'll see what happens there, but the situation is quite good in terms of the first weeks of trading this year. However, the situation is dynamic, and the dropping prices of oil may translate into a new developments. And one more slide in terms of improving the sales in the stores, revenues, mainly in LFLs. This is our main goal. If you ask me how we want to do, then I will tell you that we are planning to have 50% more models within reserved collection. So that happened already. Spring-summer collection features 50% more models. Well, it doesn't really mean that you will see 50% more models in each store. Well, that doesn't work like that. But for example, in our most important stores, for example, Stuttgart flagship stores and other big German or Polish stores, well, we can actually record better sales there and improve our revenues by adding new models, so business sport models or adding kids collections. Well, this is happening already. So we are planning to use our collections. We are planning to improve, to grow our offer. So those stores who actually sell more expensive clothes, well, we will send more clothes there, and we will actually adjust it to the offer will be adjusted more to the client's need. New employees in design departments and production departments. First and foremost, the designers. We want to encourage young people who graduate from artistic universities, art academies to work for us. Fashion is a passion, so we are very happy to employ such people, and we want more people to actually take care of our product, to work on the product, to make it better, better quality. So because that translates to better sales, better margin, and so on. And the quality control. This is how we call this area. Of course, the quality control was always there, was always in place, but it was working more on the level of warehouses and stores. But now we want to introduce it to the production process. So we send our people to visit Asian factories to supervise our production on the level of production. So they introduce our standards. So they supervise the quality of the fabrics that are bought for our collections. So we strongly highlight, so we strongly focus on this production process. So as an effect, we may probably decrease the number of factories that we cooperate with. We will be focusing strongly on quality. And this is a summarizing presentation, a presentation that summarizes 2015. So we need to mention how we observe, what we think about new markets. What do we mean when we talk about development, where and how we perceive it. So let's start with the most important market, so Central and Eastern Europe, Poland, Czech Republic, Slovakia, and Hungary. In Poland, nearly 1,000 stores. The market is quite full of our stores already, but we can see that there is a potential to win new clients. Polish clients are earning more and more money. Polish customers are trying to buy, are willing to buy premium products. Hence, we've launched Tallinder on the market to respond to the needs of our customers. And of course, the first year will be Poland. As usual, we will be testing the brand and working on it, and then we spread on to new markets. But we don't talk about those plans at the moment. Still, we focus on Tallinder in Poland, Czech Republic, and Slovakia. What will happen there? Surely there will be some developments there, but these markets are also quite full for us. Saturated for us. So we are not really planning to have some mass openings there. But in Hungary, we will have some new openings. Well, this is quite a good market for us. Really favorable conditions, really interesting situation for us. And this is a very important e-commerce region for us. So we have online stores in each of those countries. Well, of course, we're talking about reserved online stores, but we will add new brands as well. Another region, and this is the CEE countries. This is Romania, Bulgaria, and Croatia. The biggest potential is the Romanian market. Quite a lot of shopping centers are being constructed. People are interested in shopping, and the salaries are growing, so people spend more money also on clothes. So we want to participate in this growth. So Croatia is yet another new market. We started in 2014. Well, it's not big, but we will be developing there. Well, this is a very promising part of Europe. Plus, we are also looking into neighboring countries, so Serbia and Slovenia. We don't really have specific plans, but it may happen that in the future we will be opening new stores there. Baltic countries, small countries, saturated quite a lot in terms of our stores. We've been there for several years, good profitability. We can't really do much there. We are opening a few new stores there, but that's it. Another region which is very important, Ukraine and Russia, as well as two new markets, Kazakhstan and Belarus. Kazakhstan and Belarus, this is a franchise model, but in Russia, as you can see, we have nearly 300 stores, a very big market, great potential. We are very happy with the results, but we can't forget about the currency effects and macroeconomic risk. So we'll be developing in Russia, but maybe slower than usual. 2-3 years ago, it was nearly 50% growth, but now we are talking about 10% growth year on year. And Western Europe, the first country that we've entered, Germany. We have 12 countries and 4 new openings. Now, Essen, Hanover, Ludwigsburg, and Munich. Well, this is where we will be opening our stores. These will be the street stores, because in Western Europe, this is we are talking about mainly about high streets, different than in Eastern Europe, which favors shopping centers. We are planning to open a 20 reserved stores in Germany by the end of the year. And the last market, which is very promising for us, but a new market, and we've entered there last year. We have stores in Egypt, Kuwait, and so on, but we will be coming to Jordan, Oman. So, as planned, 70 franchise stores within 10 years, reserved Mohito and Sinsay brands in 6 years. We are quite happy with the sales in this region. Sales per square meter are 2-3 times higher than in Poland, so this is where the potential is, and this is why we are present there. That's everything from me in terms of presentation, in terms of brands and financial result and our plans. So thank you for your attention. And now I would like to encourage you to ask questions. But because we have online broadcast, well, please raise your hand and then ask the question to the microphone, please. So we encourage you to ask questions. Good afternoon. A few questions from me. I would like to start with the effects with foreign exchange differences. 2014, it was 200 million zloty, 2015, 70 million zloty. So how do you plan to limit those differences? In order to reduce this negative influence, this negative impact, we would have to decrease our exposure to US dollar and increase the Polish zloty involvement. And we know that it will probably not happen. Our exposure on Russia is quite high, and we still make a lot of purchases in US dollars in Asia. We are not planning any hedging strategy as well. So in the nearest future, the only thing that we can do is to decrease the exposure in terms of our foreign subsidiaries. So the liabilities from receivables from our subsidiaries are the lowest possible, but we don't really plan any special strategy for it. So you are not planning with this scale, nothing, no, nothing at the moment. LFLs now, because you've mentioned that they are supposed to grow in local currencies in Russia, Ukraine, quite dynamic growth. So back to the foreign exchange, well, a bit lower translated into Polish zloty, how that will look like in Europe. So the idea of increasing the number of models, well, you've mentioned, well, so what can you say about that? As you know, we are not publishing any plans or guidelines. We only have a general guidance, so 11% of floor space growth. We want to have a quicker, faster revenue growth, but in Ukraine and Russia we plan two-digit growth. Now, a question concerning Tallinder. In Poland, in 2016, are we talking about 10 stores or more? We hope to have a bit more than 10 stores, but we have 10 stores in mind at the moment. And this brand will not be as massively developed as other stores. So we can say that 3 times 10 in the future years. Well, we are trying to do it quicker, but please, because we're talking about some appreciation model for the company, so please assume 3 times 10. So other operating cost, other policy concerning fit-outs. What do you mean by that? As of the beginning of this year, we changed, because of our auditor, we are changing our approach towards the fit-outs. The total fit-outs were included in the profits and costs. Now we are actually settling them in time. So if we have a fit-out, a positive fit-out, we need to settle it throughout the whole contract, not at the very first beginning. So we're talking about 5-7 years, depending on the period of the contract, the term of the contract. Therefore, we have those settlements that are growing. So thank you. Krzysztof Stabin. I have a question concerning reserved in Poland, because in general we can see that there is a slowdown. So what is the diagnosis according to you? Because when I was checking H&M in Poland, we could see that the LFL is growing and they are actually developing. So maybe there is some kind of cannibalization going on with reserved. Maybe there is a problem with being outdated. Maybe we need a new blood in the brand. Well, you are actually you are actually developing in Europe. So if London is supposed to buy that brand, so if we want to base our recognition across Europe on this brand, well, I'm not an expert, but maybe this brand is not adjusted to the very expensive plans that you have. Well, this brand is well adjusted to our expansion plans, so it is the sale is quite good abroad. In Poland, we are talking about quite a big saturation. The situation is different because the brand is doing quite well. It is positioned well. Well, we are improving the quality of the offer. But it's true that if you take a look at our development, we developed two new brands in the past 3 or 4 years, Tallinder and Sinsay. So how did we get new talents, people who actually helped us to develop those brands? Well, from Reserved brand. So now we know that we need to employ additional people, additional designers in order to actually improve again and revive this brand. So we give people more time to work on the models to improve the quality of our product, and this should translate to the expected results in the near future. Are there any further questions? Maybe online question. There's one question concerning how the governmental proposal concerning the turnover tax, how that translates to our plans. So yes, at the beginning when people were talking about this tax, well, I've been following the drafts, the projects, because, and then at some point I stopped because it kept changing. Well, and I said, I really have to focus on the business, and there are just too many changes. So we are just waiting for the final draft of the law. Well, we were trying to actually make some prognosis. How this tax can affect us? Well, the last model said that about we are talking about 30 million zloty yearly of a tax that we have to pay. But this is just a speculation. We need to wait for the final draft of the act. Good afternoon. I would like to ask about the growth of other costs per square meter that you showed on slide 15. Fourth quarter, it was 52 zloty. as compared to 47 zloty in the third quarter. And my question is how permanent this growth is. Well, in my opinion, it is not permanent growth. This is one-off growth. So analyzing what makes up this cost. So this is amortization cost, which is permanent cost, energy consumption cost, the cost of materials. Well, this is what is actually growing. So materials such as hangers and so on. So this is one of cost whenever we open the stores. We also have credit card payments and so on. So I believe that the fourth quarter, this is just one of growth, and later on they will return to the known levels. Raiffeisen, I'm representing Raiffeisen. I've got two questions. Online sales, 2%, nearly 2%. Are you planning to act on improving this share? And the second question, the cost per square meters. How do you plan it? Will it be flat or grow or drop? Starting with e-commerce. Comparing the sales, e-commerce as compared to the total sales, this is about 2%, but I'd rather show it in a different light. So what is the sale in those countries that we offer all online stores? Especially in Poland, we have 6 online stores of our companies, and this is about 3% level. Of course, this is not our target situation. This is not our target. We are still developing, working on this sector. We can do more. There is the correlation between marketing and advertisement, online advertisement and sales. So this is what we continue doing. Now we are focusing mostly on developing the network of stores in individual countries. And as at today, we are working on our organization and logistics in order to be able to better advertise our stores. And the second question, cost and what to expect. Well, moving back to the cost of stores, well, half of it are rental charges. As you know, we prefer our new model because we are changing into turnover rental. So if the turnover is good, then we pay more. But if the turnover is lower, then we pay less. So we are moving on to new model, but the new contracts that we sign offer better conditions than the previous contracts. So if we renew the contracts and we want to stay in the location, well, usually we have better locations. So the rental charges should be dropping in the future. On the other hand, the personnel, the staff, and we are talking about 2-digit growth of staff cost per square meter. On the one hand, the rental charges are dropping, but on the other hand, the staff cost is growing. However, that cannot be really balanced. And in 2016, we will have the growth in cost per square meter. It will be just a few percent, but this record-setting low cost, well, this is behind us. Now we are talking about the growing cost, the growth of cost. One more thing, just to make it more precise. Well, the problem of reserved in Poland, well, I understand what you've explained us, that this brand has been maybe a little bit forgotten because people were moved to new brands, and that may be actually visible in Poland, that may be influencing the situation in Poland, not abroad. But why? Why this is a problem in Poland and not abroad? Well, my answer will be say that in Poland we have quite a strong competition, and I would tell you that a few years ago the competition in retail sales was higher, was stronger in Russia, but now this situation is in Poland. Our national Polish market is quite competitive, so there is no chance for us to increase our prices. In terms of our competitors, we have competitors and also quite a strong online trade, online e-commerce. So the structure of sales in Reserved, well, we notice that actually the best sales is in the most expensive products. So the structure, the situation in Poland is changing. People are buying more expensive clothes. Poland, a big country, a strong competition, whereas we have lower competition in smaller countries, such as, for example, Czech Republic. So the main reason for the Reserved, how it behaves in Poland as compared to the rest of Europe, is the competition. And now about the question about the renegotiation of the rentals. So what numbers are we talking about? About percent, how many percentage of contracts will end in 2016 that you will renew? I can't really tell you exact numbers because that keeps on changing, but because the average rental is 7 years, so every year we are talking about 10 to 15% of contracts that are renewed every year. And the savings, well, we will be talking about 1 zloty or something grosz per square meter. Now we'll have one more question, online question. Well, it concerns the contract renegotiation opportunity in China. Is it a scale that could secure you against the currencies changes? Have you started already the negotiations, or you are planning to do them next year? Well, I'll start with the second part. Yes, we've started it already. Whenever we see the valuation in China, so we respond to that very quickly. Of course, we can renegotiate new contracts, new orders, but we can't really do anything about the old contracts. However, whenever there is something new order, new contract, this is what we are renegotiating. Well, first and foremost, China is 60% of the turnover, and the scale we are talking about 4 to 5%. So it will not add so greatly to the total situation, to the whole. But what we are actually focusing now, as I've mentioned, is not about dropping the prices, but improving the quality. Okay, are there any more questions? Well, yes, there is one more question. I'm representing Paribas Bank. I would like to ask, what is the average gross rate per hour? Well, it depends on the structure in Poland, of course, because Reserved or Mohito brands, we have people who work based on employment contracts, but with new brands, we have students who work based on other contracts. So we are talking about average 8 zloty and higher per hour. So most of the contracts in Poland, we are talking about employment contracts in Poland. Well, the structure of contracts, yes, most of them are employment contracts. This is about 60–70% of contracts. The rest are young people, students who prefer to work flexibly. So they actually adopt the hours to the classes that they have got. So this is why those contracts are not employment contracts with them. temporary employment contracts, rather. So thank you. Thank you so much for today's meeting. I would like to encourage you to come to the next meeting. Thank you for those who came and those who watched us or online. Thank you.